Welcome to the Awesomers.com podcast. If you love to learn, and if you're motivated to expand your mind, and heck, if you desire to break through those traditional paradigms and find your own version of success, you are in the right place. Awesomers around the world are on a journey to improve their lives and the lives of those around them. We believe in paying it forward, and we fundamentally try to live up to the great Zig Ziglar quote, where he said, "You can have everything in your life you want if you help enough other people get what they want." It doesn't matter where you came from, it only matters where you're going. My name is Steve Simonson, and I hope you will join me on this awesomer journey.
If you're launching a new product manufactured in China, you will need professional, high-resolution, Amazon-ready photographs. Because Simo Global has a team of professionals in China, you will oftentimes receive your listings photographs before your product even leaves the country. This streamlined process will save you the time, money, and energy needed to concentrate on marketing and other creative content strategies before your item is in stock and ready for sale. Visit simoglobal.com to learn more, because a picture should be worth 1,000 keywords.
You are listening to episode number 73 of the Awesomers.com podcast series, and I wanted to just share that, as always, you can just go to awesomers.com/73 to see today's show notes and details. Now today, again, this is part 2 of our 3-part series with Greg Silberman, and we're going to talk more about some of his background and some of the financial things that are really important to not just entrepreneurs, but awesomers of any walk of life. That includes, any business people, any artists, any innovators, anybody who is really an awesomer out there. We need to know how to consider the management of our money and our assets over the long time. Now, as you may recall from our first episode, Greg has been personally responsible and on teams that manage billions and billions of dollars of wealth. And this type of management, this type of experience makes Greg a really great resource to listen to. So this is part 2 of 3 of this particular interview. It is a fascinating story. First of all, it's hard to top hot audit talk, but when you get into derivative swaps, I mean, come on, we're just laying it out there for these guys. This is gold, pure gold, baby. So now, Greg, I love nerdy stuff, and I'm a kind of a long-time computer guy, Linux and all that from way back. So I definitely appreciate the fact that you are the guy at a world-class firm. Still to this day, JP Morgan would be a top 5 or top 3 firm, if not the number 1 firm. And so what a great experience and what a great opportunity for you to be there on the ground floor. By the way, that image you painted of, kind of seeing the stock floor kind of open up, very telling, because that exciting floor atmosphere was something I think drew a lot of young people in, especially those that were drawing the numbers. Fascinating that you saw that. So once you got to JP Morgan and you started in that derivative business, did you find that resonated with you? Did you like that more than the auditing? It sounds like you did.
Oh, I did. No question about it. And I try to brush up as best as possible my Visual Basic skills. And so I would create VBA scripts to help. And then the whole question of valuation and linking into, Bloomberg terminals and getting real-time valuation and front office to back office. It was just a wonderful experience and a great organization. But again, Steve, it was just the scale which just blew me away. I mean, the notional value of these derivatives were, in the hundreds and hundreds of millions of dollars. And you're speaking to a South African boykie, as we call him, like a little South African guy who was used to dealing with, rands and cents. And so, again, it was compelling for me. And I thought it was almost like a puzzle, like I needed to figure out how this puzzle worked. And, certainly immersed myself. I had always been the case, but became even more of a market student, went ahead and did my CFA and read all the market greats and the great traders and try to follow and understand. And I think that's when my education really did begin, because being an investor is very much, again, leaning back onto my psychology viewpoint, being an investor is very much about knowing yourself, less so than maybe knowing the instruments that are out there and how the mechanics works. And I'm sure we might get into that, but that was really where my education began, and it was a self-education. because you really need to understand your pain points. How much pain can you tolerate in the market, or for that matter, how much greed are you predisposed towards? Because there's a selling point for everything and there's a buying point for everything, and that's normally your own thermostat which governs that.
Yeah, I think that's very well said. It is interesting, how many people will buy into something at one time or another that everyone else is selling out of, right? So that constant idea of trading, somebody sees it as a good buy-in and somebody sees it as a good time to sell. That's a classic market. So the CFA, that chartered financial analyst, I'm guessing, that's definitely a level higher than the chartered accountant. What types of things did that take you into that may have been different or unique or new at that point?
Yeah, I wouldn't say it's higher necessarily. I'd say it's just a different tilt where it's much more focused on investment, portfolio management, stock selection, fundamental analysis, technical analysis. There was some behavioral finance as well. And then there was, and not, don't get me wrong, in accounting and auditing, ethics and compliance is a huge deal, but there's a different level, I wouldn't say level, but there's a different slant to ethics and compliance when it comes to managing money, certainly managing somebody else's money. It's a huge, it's awe-inspiring, let's put it that way, and frightening, frankly, when you're helping others with their hard-earned wealth. So there was definitely a very large section in the CFA around ethics and compliance around other people's funds, managing other people's funds.
Well, that's good. That's a lesson Bernie Madoff must have missed at his week at CFA camp. I'm not sure he had any credentials, but that is a common thing that entrepreneurs especially are worried about, putting people into place that may not have the ethics or may not have their best interests at heart. How do just regular layman people out there analyze, who's good and who's bad in that context? It seems like a tough thing to figure out.
It is. Gosh, if I could write a book on it, it is super tough. At the end of the day, I believe we all have some level of gut sixth instinct, if that's what it's called. And we can judge, maybe not consciously, but unconsciously, we can certainly judge others, or we have this funny feeling. You often hear, I had a feeling about that. But I wouldn't certainly rely on that, first and foremost. So look, you've got to do your homework. You've got to understand who you're dealing with. You've got to understand their background, what they've done, what they haven't done, any issues they've had. Now, the beauty about our space is that there are a lot of regulators in the space, and there's a lot of compliance in the space. And so if you've ever come across a regulator and, were found to be a little bit naughty or whatever the case may be, that's going to be on your record. A U4, for example, is a record for a broker where all of this is recorded. And then certainly, when you're interviewing somebody to invest money with them, they would have what's known as a DDQ, a due diligence questionnaire, which should theoretically lay out all that on it. Reference checks are also of paramount importance. So you've got to really just triangulate and try to get as much information as possible. And even then, it's just not a foolproof process. I mean, there are bad actors out there, and they do their level best to show you that they're not bad actors.
Yeah, it is amazing how some of the so-called bad actors are really, really good at kind of hitting objections head on. I've seen recently a presentation, and they started out with why the IRS thinks what I'm doing is a scam, and it's like, oh, that's a very interesting way to begin. And then of course they went on to say that this is why it's not actually a scam, but that whole argument came across very well. But at the end of the day, that sixth sense was tingling. And the gut instinct is like, no, that's not going to work for me. So it is.
Yeah.
It is.
Well, there's also an element of salesmanship, and
Right.
I'm not saying that's good or bad, but again, you've got to somehow peel across that layer to know that it's not just salesmanship and it's something a little bit more nefarious.
Yeah, I think for me, your advice is very good to triangulate and figure out, from all just like you would be in, investigating any other resource or any other long-term, supply relationship, you would try to find out, as you said, referrals, any background, any publicly available information. I think all that's important. And to me, if there's a big upfront win for that, firm versus a long-term aligned objective where both parties kind of win the longer they're together, that to me is also a clue. What do you think about that? Let's pause here for a moment and take a quick sponsor break.
Catalyst 88 was developed to help entrepreneurs achieve their short and long-term goals in e-commerce markets by utilizing the power of shared entrepreneurial wisdom. Entrepreneurship is nothing if not lessons to be learned. Learn from others, learn from us. I guarantee that we will learn from you. Visit catalyst88.com because your success is our success. Giddy up.
Yeah, that's a key feature. We always talk about a win will, but the opposite to that, which I do find a very good yardstick, is that if you're in a negotiation, whatever you're negotiating, a term sheet, a sale, or whatever it is, the phrase, if both parties walk away dissatisfied, you've probably come to the most equal arrangement. So no one gets everything they want. Everyone gets a little bit put off. That tends to be the best win-win situation. And again, depending on the nature of the investment, you certainly want everyone's interests aligned. And alignment of interest normally takes place along a timeline, if you will. So exactly as you said, Steve, you don't want somebody getting everything up front and you getting the back end, or vice versa. You'd prefer to take, less on the back end, but a little bit more upfront, etc. So just so everyone feels like they are aligned and that the incentives are got everyone marching in the same direction. Again, it's very easy to say that and explain it in a verbose way. It's very hard to do it in practice, as I'm sure you are aware.
Yeah, I think it is just the nature of the beast. But I think, as you have talked about it in a very transparent way, that's helpful and additive to those out there who find themselves, looking and in the market. I know there's a lot of angst and uncertainty when it comes to investment, especially when an entrepreneur may have a liquidity event. Maybe they've taken $1 million or $2 million or maybe more off the table. There's kind of a sense that the entrepreneur's the risk profile changes, because now some of their chips are off the table, maybe all of their chips from that present business, and they want to make sure that they preserve that capital. So do you find that sometimes the risk profile changes from when they operated a business to when they have that big old pile of gold from the liquidity event?
Are you talking specifically to the entrepreneur or the business venture?
Well, let's just assume that the entrepreneur sold the business venture, so they're out of that, and they may have been, kind of mavericking it up and risky and doing what they did in business to get there. But as soon, I found anyway, often when they make the sale, that their risk profile changes when it comes to that big old liquidity event. Do you find that as well?
Oh, yes, yes and no. How's that for an answer? Okay.
Sure. Yeah.
So what I find is that it's blood, sweat, and tears to get a business off the ground and to grow it to the point where you have a liquidity event. And well done, kudos to whoever achieves that, and that when they do have the liquidity event, that they may want to take the foot off the pedal for a little bit and coast and just, I guess, gain some sanity back in their life. So absolutely, I would see the risk return profile of that person changing diametrically. Maybe there's a lot of things they wanted to take care of, but couldn't, because it was, all the chips were on black at that point. So that happens all the time. But then you get serial entrepreneurs who are, just love the game. And they're out of one, and maybe they go down to the beach for a couple of months, or travel Europe, or do whatever they want. But then they're hungry for the game again. They're hungry for the adrenaline or the excitement or whatever it is that propels them. And in they go again, and maybe they're going into something, again, all on black, but this time bigger. again, it's the propensity of that person. It's their makeup. It's how they're built. But certainly, the more wealth you generate, the more diversification you should have. It just makes perfect sense, because you don't want to go back to ground zero. You certainly don't want to go back there.
Yeah, understood. I think that's very well said. There are certainly a number of serial entrepreneurs who, some of it may just be the love of the game. Some of it, as you said, or at least alluded to, is just, it's in the hard wiring, right, of who we may be. And
yeah, it's like breathing to some people.
Yeah, I can tell you, it's that definitely, it draws me back every time. I tried to retire and I was miserable. So that did not work.
Try play golf.
Yeah, golf was fine, but after lots of golf and lots of vacations, it just got to be too much. So I had to do something to keep my brain exercised.
I hear you. Mm-hmm.
So let me ask you this, Greg: the idea of maybe a common entrepreneurial problem when somebody approaches you at ACG, what is a typical situation they may approach you with? Is there a I don't know, a common problem that they say, hey, I've got this situation and I need help with it? Is that how they approach you at ACG, or do you have such a scenario?
Well, as I said, I kind of wear, I don't wear two hats, but I have two primary roles. And one role is to, speak with the clients, go through their performance and their accounts. Again, I'm not the relationship guy. They have or gal. They have someone on point that they can call all the time. That's not me. But typically, on a quarterly basis, if the client's in the office or we go out for lunch, they want to hear from me. They want to hear about what is it that I'm thinking. And just to be clear, it's not, it's not an edict. I chair our investment committee. There are 5 of us on the investment committee. And those people all have voices, and they all have different ideas and ways of viewing the market. And again, it's my job to take that on board, but it's almost like a democratic organization where we have a vote on a change. So what I say doesn't necessarily go, and thank goodness for that, because I don't bat 100% all the time. So that's one element, is really just the spokesman, meet the client, shake the hands, and just give a brief synopsis of what we think the market's doing and how their account has been performing. So that's maybe a problem or a role that I facilitate. The other one, frankly, is the sifting through of investment ideas to find that one little golden nugget. And I got to tell you, and I think you can look at the industry norm, you probably will have to look at 100 investments before you make the one. So 1 or 2 out of 100, you got to sift through and do some kind of due diligence before you find that 1 or 2. And even if that 1 or 2, you got a high likelihood that both of them are not going to work out. So it's a very tough job to identify the winners from the losers. And that's certainly a problem that I've worked on my entire career, and I continue to work on, and to refine myself and to refine certainly the people that I talk to and listen to as far as investment ideas are concerned. So that's more art than science, and it's not something I think I'm ever going to get perfectly right. But it's certainly a problem that I've taken on board, and it's something I need to work on continuously, Steve.
Boy, I can see that it would be an endless, almost treadmill of work to keep that the idea flowing, happening, and the vetting process happening. So much to be done. When you guys at ACG, and as I recall, you're the CIO there, so I'm saying Chief Investment Officer, is that right?
That's right. Yep.
Yeah, correct. And so when you, as a company, look at things, are your clients going into individual deals? Are they going into portfolio deals? How does it work for the client side?
Again, we favor diversification. So we run a number of strategies. We'll run, for example, a large cap growth strategy where myself and some of my team are actually selecting the stocks. So we'll build a portfolio of 15 to 30 stocks, and the clients will go into that portfolio of stocks. On the private equity side, we have some private equity funds, if you will. And so a client will never go into one single deal, but they may. And if we find something that we really like and is very compelling and we may show it around to some of our larger relationships, and they may want to have a small bite at it. But those relationships would be very aware of the risks and rewards of one single deal. Clearly, one single deal has got much higher risk-reward ratio than a 30-stock portfolio. So, as I said, diversification is always the key. You never know which one's going to work out and which one isn't, and you're always surprised by the outcome.
Yeah, boy, that's a surprise. Sometimes they're good surprises. Sometimes they're not so good surprises.
That's right. Yeah.
Yeah, that's just the nature of the beast. We're going to take another quick break. When we come back, we're going to talk a little bit about the future, maybe even whisper the word cryptocurrency, and also get some opinions from Greg about some of the differences of investment strategy. So we're going to do that right after this break. We'll be right back.
Hey Amazon Marketplace professionals, this is Parsimony ERP, and we get one question over and over. Can you please tell me exactly what Parsimony does? Well, we'll try, but this is only a 30-second spot, so we're going to have to hurry. Connect to your Seller Central account and pull all the new orders. Enter the orders with all customer data. Enter all of the Amazon fees and charges. Store them at the item level. Generate profit and loss reports at the SKU level. Automatically generate income statements. Handle multiple companies. Handle multiple brands. Handle multiple currencies. Facilitate budgets and forecasts. Store all customer interactions in a sophisticated CRM system. Manage your supply chain. Project and task management. Maintain an audit log. Hey, you get it. That's Parsimony, PARSIMONY.com. Parsimony.com. We've got that.
Well, once again, Greg's dropping knowledge bombs on us and really helping articulate why people need to think about their finances maybe in a little bit more comprehensive way. And I like the idea that we've talked about this concept of, the behavioral side of the investment equation, because not everybody's built the same way. As I have talked about with Greg and other times, both on the podcast and off, people approach money differently. They approach their comfort with investing or building assets or building wealth, capital formation. They do it differently. And I think Greg has been a really great instructor to help us think about some of these issues. And I hope it gives you personally the chance to really reflect on, are you doing the right things? Could you be doing something different? And if so, what actions are you going to take as a result of that? So as a reiteration, this is part 2 of 3 with Greg Silberman here on the Awesomers.com podcast. And this has been episode number 73. Once again, all you have to do is go to Awesomers.com/73 to see all of the show notes and details. Well, we've done it again, everybody. We have another episode of the Awesomers podcast ready for the world. Thank you for joining us, and we hope that you've enjoyed our program today. Now's a good time to take a moment to subscribe, like, and share this podcast. Heck, you could even leave a review if you wanted. Awesomers around you will appreciate your help. It's only with your participation and sharing that we'll be able to achieve our goals. Our success is literally in your hands. Thank you again for joining us. We are at your service. Find out more about me, Steve Simonson, our guest, team, and all the other Awesomers involved at Awesomers.com. Thank you again.
Awesomers.com